Another stock that has been beaten down a lot in the stock market is actually Adobe, and it's down over 49% from its peak. And this is actually not my first video on Adobe, but again, Adobe is now sitting pretty close to what it was before the March 2020 crash. Pretty much 2 years of gains were wiped out, and a lot of Adobe shareholders are pretty upset with how the stock has been performing. So in this video, I'm going to take a second look at Adobe, try to assess the situation with Figma, and just look at my valuation model in general and try to look at how much upside can we actually get if we buy Adobe at such prices, because the stock had a pretty bullish price action since it looked like it pretty much bottomed out around 270, and it has been making higher highs and higher lows. So it's going to be pretty interesting that maybe Adobe stock has actually bottomed, and maybe it's just priced in all the bad news, maybe like Meta actually did in 2022. This is what I'm going to try to talk about in today's video. So again, I hope you enjoy it. Now, to begin, most of you are actually familiar with Adobe. I don't need to introduce it to you. A lot of their Photoshop app, a lot of their other things. They have the Adobe Cloud. They have their own PDF type of product. This is their flagship product, which has a pretty deep moat, and their business model is mostly recurring revenues, mostly subscription. I believe 97 or 98% is recurring subscription revenues. They have over 37% net income margins, which I mean is pretty amazing, and it's a pretty amazing business model. But there was a lot of reasons why the stock has been beaten down so much. Most of it had to do with how the business has been performing. They had a tough time comparing what they had in 2022 to what they had in 2021, where we had peak bubble, peak everything, peak demand in a lot of things. So they had a tough time actually trying to compare these quarters. And now Adobe actually went up on earnings because they lifted their profit forecast for 2023, and they actually beat their estimate, and they kept revising their guidance as the stock was going down. And now it looks like maybe Adobe's bad times could actually be behind it, as they actually did beat on estimate, and they even raised their guidance. And the most important thing that many of you are actually watching is the whole thing with Figma. Is it going to go through? Is it not going to go through? And it was funny to me how Adobe stock actually went down whenever the Figma acquisition, they said that maybe it's not going to go through. But to me personally, I believe they're actually overpaying, and I don't think it would be bad if the Figma acquisition doesn't go through. I believe it could actually be a good thing for Adobe. So I'm not sure why the market reacted this way. I get it that Figma is a competitor to Adobe and stuff, but I personally believe Adobe is overpaying for this acquisition. But I believe either ways, Adobe could either make something good out of this acquisition and integrate it and do something good. The CEO is pretty amazing, or maybe it's not gonna go through. But I believe Adobe should be fine if this whole thing doesn't go through. But it was pretty funny to me how Adobe's stock actually reacted. And it's been engaging with a lot of talks with regulators from the US, the UK, the EU on it spending $20 billion, and they said they are prepared for the next steps. So again, it's not sure if it will get approved or not. I believe it will most likely go through, but maybe it won't go through. But I believe Adobe should be fine either ways. And a lot of people right now are pretty much not big fans of Adobe stock because of the whole thing with AI. A lot of people are talking with AI, and a lot of other creators, they use a lot of the type of tools, a lot of those apps that Adobe actually have. And if you have an AI that could do all those things for you, so why would you need Adobe? And I'm not a big tech person, but I did some research, and I believe Adobe is actually integrating AIs in many of those of their type of apps, many of their websites and stuff. So again, I don't believe Adobe is stupid, or the CEO of Adobe is stupid. I believe they're doing something around AI, and I don't think Adobe is just gonna go dead because of AI. Although it's a serious risk for the future of those apps and the freelancers, all that type of stuff. But again, I believe Adobe should be doing something about it, and I think they are doing something around it. But I'm not gonna try to predict what AI is going to do. I'm gonna focus a little bit more on what Adobe is right now and focus on the business model. And looking at their income statement, again, it's an amazing business model. Subscription around 97, 98%. It's recurring revenue. revenue, high margin revenue. They have very little cost of revenues on those subscription. Pretty amazing business model. Out of those $4.6 billion of revenues, they netted around pretty close to 4.1 billion of gross profit. So it's a pretty amazing business model. But they do spend a lot of money on research and development and on sales and marketing. And they had a pretty big increase in sales and marketing and in research and development, which actually led their operating income to pretty much be flat and their net income to actually decline year on year. And this is something that's very concerning to me. I don't like companies that decline in net income, and this is something we have to watch, for the future, if this actually keeps continuing with Adobe or not, because it could be telling us a lot of stories that maybe, if Adobe actually doesn't put all this money in sales and marketing, maybe the growth is going to slow down. So it's not at a competitive position as many others actually believe. And that could be a sign of weakness from Adobe, which is why we should be actually watching this every single quarter, watch the trend with net income. Is it going to decline? Is it going to at least stay flat or grow a little bit year on year? And this is something very important to watch. Now, looking at the balance sheet is, pretty good so far outside of the Figma acquisition. I believe they're going to use some shares and stuff and some loans. But again, looking at the balance sheet of Adobe, they have around $8.3 billion of current assets. Their current liability is $7.4 billion. It's more than well covered. They have around $3.6 billion of debt, of long-term debt. And I believe this is not a big concern with Adobe, as it's a free cash flowing machine and it's not due until some time in the future. So I don't believe the balance sheet should be a concern if you're actually investing in Adobe. Now, some things that should be a concern if you're investing in Adobe, and this is something that I would really like to point out with Adobe and a lot of those tech stocks. And this is that if you look at their EPS, earnings per share, look at the massive difference between GAAP and non-GAAP. The GAAP EPS is 1085 to 1115. The non-GAAP EPS is 1530 to 1560. This is more than a $5 difference between GAAP and non-GAAP. And this doesn't really happen. This is not normal, but it only happens with a lot of those, tech companies. Why does it happen with the tech companies? Because of stock-based compensation. They don't adjust for stock-based compensation, therefore the EPS looks much better than it actually is. Although the stock-based compensation, it's a real actual expense. And this is the reason for the big difference between GAAP and non-GAAP. And it makes a huge margin of how you actually value Adobe. And most people value Adobe with non-GAAP, some of it value it with GAAP, but it's a big difference between those two. And this is something you should be concerned on and you should pay attention to whenever you're investing in Adobe and in many of those type of tech companies, which I try to personally stay away from tech companies mainly from this reason. But Adobe is actually doing a little bit better than other tech companies, because if you look at their shares outstanding, it has been staying flat and it has been even going down. So Adobe has been buying back stock to actually offset the dilution from stock-based compensation and actually decrease their shares outstanding as their stock went down. And this is something good from the management. But me personally, I am not a big fan of the stock-based compensation expense. And this is one of the reasons why I try to stay away from tech companies. I like, boring companies and some type of industries, necessity type of businesses. So I try to, stay away from tech. But this is just my personal opinion. Now, using their forward PE ratio, which the forward PE ratio is actually based on their non-GAAP EPS, not their GAAP EPS, but using the non-GAAP EPS, because this is what we have, Adobe now is trading around 22 times earnings. With GAAP EPS, it's trading around 31 times earnings. But 22 times earnings or 31 times earnings, both of them are actually lower than their mean average of around 35.5 times earnings. So you can see that there's some concerns around Adobe as a company, and this is why the stock is down 50% from the peak and is trading at 22 times earnings. It used to trade at a mean of 35 times with as low as 18 times and as high as 62 times earnings. So we can see that in terms of a multiple basis, we are actually closer to the low than the high. And this is something good, that we could potentially be getting a good deal if we're buying Adobe at such prices. Now I'm going to get in my valuation model with Adobe, but I would like to remind you about the difference between something like Adobe and something like, for example, some type of a dyeing company like a tobacco company or an airline company. Something like Adobe is actually a high quality business, and a high quality business that earns higher returns on capital or returns on invested capital actually deserves a higher multiple than a company that's just, that's not doing anything and earns 5 to 6% on capital. This is something very important that you must know, because a lot of people claim that Adobe should be trading at 15 times earnings or at 13 times earnings because, it's slowing down, there's no negative net income or whatever, but they don't pay attention that Adobe has 37% net income margin and it earns around 32% return on capital. So this is something you have to include in your valuation model and you have to pay attention to whenever you're assigning a fair multiple for Adobe. And now I can get into my valuation model to try to determine a fair price for Adobe, and I use the recent revenue, which is around $17.5 billion of revenue. I used a 10% sustained growth because the analysts have around 12%, so I use 10%, and I believe 10% is fair for Adobe, and if they keep going those 10% till 2027, they're gonna have pretty close to $28 billion of revenue. Their net income margin, as we talked about, is 37%. Now 37% would translate to pretty close to $10.5 billion of net income by 2027 using a multiple of 25, which is, again, this is what I was trying to talk about. Now Adobe is trading at 22 times and it's traded as a mean of 35 times. Now me personally, I like being more conservative and I don't like using the mean or the higher multiple. The best case scenario could be Adobe getting back to 35, but this is not something that I want to bet on it. This is a plus if it gets to 35, but I want to try to assess the base case scenario first before I get to the better case. So the base case scenario is Adobe actually trades at 25 times earnings, which I believe is a fair multiple for a company earning 37% net income margins, recurring revenue business model, high returns on capital, pretty decent growth. I believe 25 times earnings is pretty fair for this company. And using a 2%, it's not a dividend, it's actually a buyback, meaning if Adobe keeps buying back 2% of their market cap every single year, the total upside would be 70% or 12% compounded every single year for the next 5 years. Now, this is not a bad return with Adobe, but for me personally, to try to get a double on Adobe with my fair value and stuff, my valuation model tells me that I have to buy Adobe at $275 per share, which $275, I believe it was pretty close to the 52-week low. And this is what my valuation model actually said before in my first video, and now in my second video, it's still $275. So $275, you could pretty much get 100% return over the next 5 years if you'd buy Adobe at $275. Now, this would change if you actually assign Adobe a multiple of, a mean of 35 times earnings, then the upside from here is 134% or over 19% compounded every single year for the next 5 years. But if Adobe's growth actually slows down and then the sentiment gets much, much worse, and we use 20 times earnings on those type of numbers, the upside is only 38% or 7% compounded every single year. So Adobe could be a buy if you believe it's going to trade at 25 times earnings or higher, and if you believe they're going to get a 10% revenue growth, which I believe they will. But for me personally, Adobe is not a buy, again, because I try to stay away from tech companies. If Adobe gets to my fair value of $275, I would potentially open a position. I actually haven't opened a position at $275. If it does go back to $275, which it might, I might actually be interested in potentially opening a position. But at this price, for me, Adobe is not a buy. But if you actually believe it could trade at 25 times earnings, as we talked about, or a little bit higher, Adobe is not a bad buy at such prices. So again, thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.